More investors are betting that the Fed will, in fact, cut interest rates again next month. Bloomberg said that Kevin Hassett, a Trump ally, has become the front runner in the race to replace Jerome Powell at the Fed. And of course, that is seen as, if he takes over the job, it's seen as inclining the Fed to reduce borrowing costs still more. Let's get more from Karl Schamotta, Chief Market Strategist at Corpay. Karl, thanks very much. Always great to talk to you. Getting inside the councils, the labyrinth of the White House, very difficult. But if Kevin Hassett were to become Fed chief, would he be enough to sway the central bank to cut interest rates faster?
I don't necessarily think so. That's kind of the funny part. Right now, markets are clearly anticipating a more dovish, policy response from the Fed going forward. There's definitely the idea that Hassett will steer the committee toward delivering more rate cuts on a shorter timetable. But the reality here is that the Fed is a consensus-driven institution. It does require a majority of the committee to approve a rate decision. And if anything, the White House appointing someone who's very clearly partisan and very clearly, sort of being put into the role on the basis of his loyalty to the president, that actually might mean that other committee members are a little bit more reticent to sort of, go with the flow. I think to some extent we might see, the economy really driving those decisions as opposed to the dovish impulses of Hassett himself next year.
And what is your take, Karl? Is the U.S. economy weakening decisively, or is it hanging in?
It's not decisive at this point. Clearly we're seeing a rolling over in consumer sentiment and indicators like that. On a soft basis, a lot of the indicators that you look at are telling us that consumers want to be more cautious, and that investors and businesses are also, sort of moving to the sidelines to some extent. But when we look at the hard data, virtually nothing is showing, a hard, decisive pivot in the economy. Reality is that consumers are still out there spending. If we look at higher frequency data releases, they're pointing to a year-over-year increase in retail spending, for example. Businesses are still investing. We're not seeing that sort of, that decisive or clear-cut evidence of the economy running into a wall. That being said, when we think about how the Fed is setting policy right now, they are thinking about this from a risk management standpoint. If you look at what a lot of the policymakers have been saying recently, they've been saying that if we see, labor market conditions soften a little bit, that could raise the risk of a non-linear downturn in labor markets and then across the rest of the economy. So they're inclined to deliver what they might characterize as a risk management cut, as opposed to, this sort of aggressive easing campaign. And so, I think that the evidence is not there yet. But when we think about how the Fed is going to approach this, they're probably going to err on the side of caution. They're probably going to want to ease policy a little further, and then wait for next year when the real effects of this year's policy turmoil begin to show up.
Give us your thoughts on the British budget. Rachel Reeves, the Chancellor of the Exchequer, talking about £26 billion of tax increases. But there was chaos. A bunch of data got released early, and she's not happy about that.
No, I really can't blame her. It was chaos on trading desks around the world as well. The funny part was when the document was released by the Office for Budget Responsibility, I didn't know if it was real. I wasn't totally sure if it was a misprint, a reprint of something that had come out before. There was a lot of skepticism initially, and then it became clear that it really was an accidental release of what she was about to say. And it did cause a little bit of havoc, but when we look at what was laid out in the budget, it sort of aligns with what markets had anticipated. It does, point to a degree of fiscal discipline. The government is looking to avoid sort of an increase in indebtedness over time, an increase in borrowing. They are not pushing the limits as the Liz Truss administration did a few years ago. That that has meant that, the gilt market, that the pound itself have not moved all that dramatically. However, there is a bit of skepticism embedded in all of this, because if you look at how the budget is sort of temporally set up, we have a lot of spending coming through in the short run, and the tax increases kind of kicking in over a prolonged period of time. So it's like a front-loaded budget, right? We're familiar with these, of course, being here in Canada, but the reality is that markets, when they really look at this, are going to really say, well, how many of these projections are really going to be borne out in reality? What path is the UK on? And unfortunately, I think that at the end of the day, the UK's vulnerabilities are still going to remain on display.
In particular, their uncertain future in trade after they quit the European Union?
Yes, Brexit has certainly inflicted damage on the UK economy. There's no doubt that in the years since the referendum that the pound has traded lower, that trade relations have not remained on an even keel as much as they did before. But the bigger story, I think, is just a very simple one, and it's that the UK is running a twin deficit, right? They're running a very big fiscal deficit, as well as running a trade deficit. And so what this means is that on an ongoing basis, they need to attract foreign capital. They need to attract capital from the rest of the world, or get UK entities to give up some of their foreign holdings and bring them home. And so what this means is that you have sort of an ongoing vulnerability. Whenever there's a shock or a loss of confidence in the UK economy or in the government's fiscal stance, then we tend to see a lot of downward pressure placed on the pound. And so what this has meant is that the pound has consistently traded in a more volatile range than its counterpart across the channel. And that doesn't seem likely to lift anytime soon.
Our own Prime Minister, when he was head of the Bank of England, was outspoken in warning of the dire consequences of Brexit. He has his critics in Britain, people who are fans of leaving the EU. But have his concerns been borne out? I guess this is a thing that will play out over decades. Was it a bad move for Britain to leave the EU?
It's hard to say in the very, very long run how this will pan out. But, if we look at the efficiency of the economy, I would certainly say that this is sort of on par with what Trump is attempting to do with the U.S., right? The day that you put a lot of sand in the gears of international trade and international capital flows is the day that you make your economy less productive in the long run. And so, we are seeing that pan out. I think most British citizens at this point are expressing what in colloquial terms a few years ago started to be called regrets. The idea that they regret voting for Brexit in the first place. But yeah, and the other thing I would kind of highlight there as well is that it was actually Mark Carney who stated the problem quite succinctly. He said that the UK is dependent on the kindness of strangers from a capital flow standpoint, right? And that's what us currency traders are watching all the time. We're watching, how attractive is the UK to international investment, and unquestionably, Brexit has damaged that standing over time. Perhaps it'll pivot someday. Perhaps it'll be a really good thing to be on an island and outside of the continent. It might actually pan out in the benefit of capital flows, but for now it's definitely considered a vulnerability for the UK economy and for the pound itself.
That's interesting. I mean, because that's always been the case with Britain. I think their currency has been vulnerable to capital flows. Remember in the 70s anyway, they would have these currency crises. They'd have to get help, international help, to support the pound.
Yes, actually, going way back, I was thinking about the Suez crisis a while back.
Oh, yeah.
So back around that time, the Americans basically held the UK over a barrel and said, you need to step back from this Egypt situation, or we're going to stop funding you. So it was very much as if the UK was an emerging market. Then, of course, we had the '92 breaking of the Bank of England by George Soros and other currency speculators. All of that has induced a degree of PTSD in currency traders. I think post-traumatic stress syndrome, right? And actually, I shouldn't just say that it was the breaking of the Bank of England that reminds us of all of this. Clearly, the Liz Truss episode was an absolute shock, and has reminded everyone of the frailty of British financial markets. And so, yeah, unfortunately, all of that means that the UK has to put its fiscal house in order in a way in which other major economies have not had to in recent years.
Karl, always great hearing from you. Thank you very much.
Thank you.
Karl Schamotta, Chief Market Strategist at Corpay.